I'm Harry Packer, a first-year student at Anderson and the incoming Anderson Investment Association president. I'm delighted to welcome you all to this panel discussion on investing in an era of data and technology proliferation. The effective use of data and technology has become mission critical across the value chain in the investment management industry, from the use of new and alternative data sets to drive investment performance to technology-driven operational efficiencies and deeper customer engagement. We are delighted to have a diverse and distinguished panel to give us their unique insights into this ever-changing area. Our panelists today are Ryan O'Grady, CEO and founder of Rowe Asset Management, Anderson alumni David Plecker, the Global Head of Fixed Income at Dimensional Fund Advisors, Emmanuel Valod, CEO and co-founder of SumUp Analytics, and as moderator, Professor Andrea Eisfeld, the Lawrence and Laurie Fink Endowed Chair in Finance. Please join me in giving a warm welcome to our panel.
Thank you so much. So I'm going to start just by letting you guys introduce yourselves, give us a little bit of your background, where you came from, where you're going, and if you want to start by touching on also the ways big data, data analytics, machine learning has or has not changed your investment management business. We'll start with you, Dave.
Okay, let me start. My name is Dave Plecker. As introduced, I'm the Global Head of Fixed Income for Dimensional Fund Advisors, class of '87, Anderson. Happy to be back. I've been in the bond market now for 30 years. I'll have 30 years at Dimensional next month. And I've been around long enough that I'm thrilled that we even have data. I remember the world in a world basically before data. If you think about things like, stock index returns, you think in terms of like a century's worth of data. If you think about bond indices, organized bond indices, I work in the fixed income markets, they didn't even get started to the early 70s. Mm-hmm. So we're looking at, a 40-year data set is a relatively small amount of data. But even more important, to me, one of the big breakthroughs that happened in the middle of my career is just post-trade transparency on price. So, you think about the equity markets, you think about the ticker tape, right? Everybody, used to go to Times Square. Everyone had their ticker tapes going once they figured out how to use an LED. I did some research on the equity market ticker tape, the idea of, when a stock trades hands, that we should disseminate publicly that information, the ticker, the price, the number of shares. That goes back to the mid-19th century, from the advent of the telegraph machine. That concept, that post-trade transparency, didn't hit the bond market until 2002. Mm-hmm. We were 150 years behind the stock market with the NASD, now FINRA's TRACE database. So that was a massive game changer for us, that we could see trades, actual transactions, now within 15 minutes of the trade. We could see the bond, we could see the price. Prior to that, you were just sort of left to your own devices to figure out whether you thought a price was good or not. So I think we welcome the era of big data, and I'm looking forward to more of it.
Okay, great. Thanks a lot, Ryan.
Yes, my name is Ryan O'Grady, and I'm essentially head of research at Rowe Asset Management. And for me, data started very early on. My first job was as a desk trader, so like with the two phones and the mine and the yours, and screaming and yelling all around me. And my boss noticed that I kind of wilted under that sort of pressure, and I just found myself uploading data and trying to take the ideas that I had in my head and code computers to tell me when I should or shouldn't do things, so that instead of stressing out in the moment, I could just look at the computer and it would tell me what to do, and then I could go ahead and do it. And if it was wrong, I could blame the computer. So then, and that kind of took off from there. And it really, having an initial trading experience and to be working from a point of view of, hey, I got this idea, and I bet if it worked the way I think it's going to work, if I pull this data or that data, I'm going to see certain things. And so as data has become more and more accessible and more granular, it's really just created a renaissance of what we're able to work on. So now, when we're reading academic papers and someone has a theory about something, it's much easier to go out and test it. But then, of course, on the other hand, it's much easier for everybody else to go out and test it. So there's an issue with what is the decay of something. Rick Kane was talking about, finding alpha, and that's essentially our entire job, is to find alpha. And then there's way more alpha to find, and it lasts a lot less, or its shelf life is a lot shorter than it used to be. So, so it's sort of a double-edged sword from that point of view. But yeah, so it's a battle that we're fighting constantly. There's always new data being released in our space, and it's our job to figure out if it's useful or what can we find.
Got it, Emmanuel.
So hi everyone, I'm Emmanuel Valo, CEO of SumUp Analytics. My career in finance started with data. I mean, I was from a mathematician with no understanding of finance, and I was like, well, I'm going to be looking for the asset class that has the most complicated math, because that's where I'm going to be helpful. So I started in mortgage-backed securities, and after about a week, I realized that actually that wasn't quite enough. So the transition from there was to say, okay, what's basically the right balance between how much data you may want to look into, how much of that data you need to understand, and what's the question really you're trying to answer. So basically that's what I did the past few years. Eventually it led to us creating this company saying, well, a lot of people have too much data that they are actually incapable of analyzing the way they want by lack of having the right tools. And we believe that we can actually get these tools to people without pretending that we provide the answer, rather by telling them we can facilitate the question aspect. So that's been really the core focus of what we've been doing.
Cool. If you don't mind, I'm going to ask you guys a couple follow-up questions that kind of speak to something you mentioned. So Emmanuel and I actually met through mortgage-backed securities, and I'm also very interested in bond markets. And one of the things that I think is so interesting about bond markets, very different from equities, is that they're traded over the counter, and they're not all the same. So we have tried to standardize credit trading instruments with credit default swaps, but the liquidity in that market isn't what it was pre-crisis. And so I'm interested in how you think data is changing liquidity in bond markets and intermediation in bond markets.
It's a great question. Very timely question too, because I talk about having now this post-trade transparency and how that's changing the world. One of the things that's happening is the way you would traditionally trade a bond is a process we'd call RFQ, or request for quote. You'd call up a dealer and you'd say, well, where could you offer me this bond? In fact, what you do is call multiple dealers, tell them they're in competition, where could you offer me this bond? Or if you want to sell a bond, where could you bid this bond? You'd get multiple bids. But there's always a dealer involved. There's always a dealer in the middle. So the way a bond moves from seller to buyer is seller to dealer. He's going to buy it on the bid side, mark it up to the offer side, and then go from the dealer to a new buyer. Well, now that we're in this world with much, much more post-trade transparency, we're finally figuring out in the bond market, again, we're only about 25 years behind the equity markets, and this one we're starting to figure out peer-to-peer trading, where buyers and sellers can learn to find each other directly without going through a dealer in an anonymous way. And I think that's probably the second biggest game changer in my career. First was Trace and this post-trade transparency, and then we figured out what to do with it. We figured out that in the end, when I look at the corporate bond market, for example, there's the total corporate bond market is about in the U.S. about $9 trillion, all held by investors. And I look at dealer inventory at any point in time, and it might be 30 or 40 billion dollars. So if I'm looking for liquidity, I'm thinking about the 9 trillion, not the 40 billion. So we're starting to learn how to find each other directly. And now the process now is what we'd call, instead of customer to dealer request for quote, we'd call it all-to-all request for quote. So now all participants in the market, investors and dealers, we're all sort of swimming in the same pool now. And so we could go out to the whole pool of market participants and say, where would you bid this bond? But more importantly, not only can any participant in the pool request a quote, any participant in the pool can provide a quote. Now that's, I spent the first 25 years always being the person requesting a quote. Now for the first time, someone else is looking to sell a bond, happens to be a bond we want to buy, I can make a bid on that bond, I could provide a quote. And that is, I think the future of bond trading, I think that's the direction it's going.
Okay, very interesting. Ryan, I wanted to ask you a little bit about this frequent but short-lived alpha. I'm interested in some examples and how alpha has changed over time. You trade in FX?
Well, FX and then commodity futures and like equity and bond futures also.
Okay, so any of those markets. I know in FX, big things changed when we went electronic in 2000, but we've still seen these big deviations even in covered interest rate parity. But yeah, tell us about these frequent short-lived alpha. And
I mean, here's like kind of a famous one, is that there's the GSCI, the Goldman Sachs Commodity Index, and they had built futures and ETFs built around this index. And for transparency's sake, they would publish, here's how we manage this position. We hold futures in the front month, and we roll them at 11 whatever a.m. on a certain day. And then more and more money flowed into this product to the point where some of the data scientists, us included, were noticing, man, if you just do this trade 2 days before and then get out of it 1 day after, there's this massive amount of money that you can make because they're jamming the roll on that day at a really predictable time. And so we would have these back tests that show like no return for long periods of time and then just go up a ramp at a Sharpe ratio of 3. And then if you run that study now, it goes dead flat. A couple of years ago, because they figured out, maybe we should randomize and scramble and spread it out over a couple of days and spread the position over a couple of different futures instead of broadcasting exactly what we're doing. Now the thing is, the quant community didn't find that because they read the prospectus, they just found it through data analysis. Like we didn't even know that that's what we had found right away. It kind of came up afterwards when we were talking about what we were doing, and they're like, oh, it's because of this. So yeah, I mean that's something, and now it's gone. Like that's gone forever.
Still on the Bloomberg index though. They still do it that way in Bloomberg.
Yeah.
just a quick follow-up on that. That's something that I'm really curious about. Is most of the most valuable data that you use today about asset fundamentals or about other traders' positions and flows?
I mean, for us, it's trades. Like it needs to, like we'll pull data on countries, trade balances, trade flows, inflation, things like that. But that data is well-worn. We're not going to find something amazing and new there. So really what we're trying to do is find things where there's been a trade, and then a model can figure out, like, why did someone trade this 3-month out, way out of the money option, like in that size? What's going on? Like those are the pieces of data that are becoming, so that's for us. It's because there's having this intuition underpinning to everything that we're doing. There's always, like I think it was mentioned earlier, this greed fear cycle, and that a lot of what goes on in markets, it has to do with human psychology and investor preference. Let's say people have nonlinear utility curves, and so that you'll find places where you can sort of come up with some alpha in the data from that.
I love that. I wanted to actually had a bone to pick with that, because it sounds like you're bringing things back to the central tendency by playing against the preferences that are maybe outsized.
Well, I'm not a statistics. That sounds like statistics. Actually, I have a master's in statistics, but it was a really long time ago. I don't remember.
We won't push on that.
Okay.
We won't push on that. Emmanuel, I wanted to ask you, because we got some questions submitted by our students, and everyone is very interested in what are your clients interested in. So if you can talk to us a little bit about the data sets that are in most demand.
So without naming specific clients for obvious reasons, but giving a general sense. The scope of clients we have is covering mostly US hedge funds, US mutual funds, Chinese hedge funds, Chinese mutual funds. That's about 90% of our clients, including extremely large asset managers. The motivation there initially started from 2 angles that are actually completely opposed. One angle was the world I come from, quant guys. Quant guys who've been running for 10 years are seeing their Sharpe ratios going from 2 to 3 to below 1, and then seeing capacity of strategies going from $10 billion to less than a yard, right? And then what they realize is that so longer horizon that strategies ROW, for example, is used to, right? Like several weeks of holding period. What they're realizing is the numerical data they have access to, everybody has access to it. Everyone knows how to understand that numerical information. And then the differentiator is mostly a differentiator on the portfolio construction and the execution. That has a high barrier of entry in terms of just the cost you need to put to get that quality of execution. Many firms cannot do that. So their demand was to say, well, can we actually process data that is extremely costly to process? And text, of course, so that's why we exist, right? Text comes prime in mind. And the reason is text is extremely noisy. Right? If I give you a bunch of stock prices and I ask you, well, how much of these stock prices is actual information? About 100%. Now, if I give you some 10K filings or some central bank documents and I tell you, well, how many of these words are actually information, that's less than 0.01%. Right? What it means when you process it, it will take you 1,000 times longer to converge to an answer with the same accuracy. So they are coming to us to say, well, I'm not going to wait 3 months to run an experiment, right? R&D is going to go through the roof. Can you give me an access to that data that I don't need to develop that infrastructure? And can you bring it to a level of performance that I can consume any kind of text in any language and get backtests done within a few seconds to a few minutes? So the typical sources that all of them have been asking, central banks. Right? And I think that makes sense for fixed income managers. It makes sense actually for anyone in a FICC space. A handful of the large single name positions need that too, which is, right, if People Bank of China tells me something about corruption and my portfolio is a US portfolio, why do I care? Well, I care because a lot of the companies in my portfolio are exposed to foreign accounts, are exposed to foreign policy. And why would I trust that the English content from PBOC is the actual reflection of what they're already saying? Mm-hmm. So I need to process Chinese and extract an insight. The second type of angle we've seen is coming out of the news or the social media. People telling you, okay, I know Twitter has a bunch of noise. Some guys actually are propagating insider information on there. Elon Musk, prime example. SEC will tell you that it's maybe not tradable. His bank account certainly say that it's not after the fine. But there, the angle is a bit different. The angle there is to say, well, you will stay solvent shorter than the market may disagree with you, right? So if the media overall is pushing for something and you think it makes no sense, but overall markets are responding and you lose P&L every single day, how long before you cut your position? And so there the questions were, well, how can I actually consume hundreds of thousands of articles on a daily basis and synthesize things that may be contrarian and nonsensical to me, but still move market? Main sources we've seen across the spectrum.
Mm-hmm. Cool. Dave, I'm going to come back to you. I wanted to ask you whether you think that big data, machine learning, or faster processing of bond prospectuses will change bond trading, and will it change what firms get financed and at what cost of capital?
That's an interesting question. Well, the process of new issue underwriting, it takes time. So I think that I don't know that if you have a machine that could read the prospectus for you and summarize it, would necessarily change the deal price, in the end. Or if a company, if the capital markets don't want to supply debt capital to some company because they're so shaky, I think whether you have a human reading it or a computer reading it, you're probably not going to get the debt capital. So I don't know. I don't see that maybe so much on the new issue side, but certainly I think faster processing of data in the secondary market certainly has to keep prices closer and closer and closer to where they ought to be.
And do you think there's any specific part of bond contracts that people will be able to pay more attention to? So like as academics, we think a lot about, so we heard a lot about covenant light in the last kind of debt cycle. We're hearing now about not just covenant light, but covenants that have caps on them or special restrictions. And I think that there are people doing value investing, fundamental investing that are reading through those things, but it takes a lot of time.
Well, that's true. But the question that I guess you're asking is there, in the current era, let's say if there are not a lot of, computers reading these documents for us, do we think that some of that is sort of falling through the cracks? And at least in the liquid public markets, our market, the real question is, our markets on average getting the price right? And we would argue that certainly in the liquid public markets, I guess one way of describing, sort of the efficient market hypotheses, one way I describe it is that, we're all in search, all investors, when they look at securities, you're in search of, what is the real value, the fair value of this security. And we would suggest that in the current market price is probably the best proxy for that value. So we don't think the market's missing a lot in the liquid public markets. If they were, then alpha wouldn't, this shrinking half-life of alpha, it wouldn't be so hard to find. Rick Kane would still be seeking that alpha if it was that easy to find. So.
Okay, let me then feed you something that maybe would be, I think we come from like the same kind of like intellectual background. So do you think that the improvements in market liquidity will be priced into bonds? If we can trade directly with each other, we're not so worried about not being able to unload the bond when we want to. Is that going to be priced in, and is it yet?
Yeah, no, I think it is. You know, I think there's a sort of great, now this is certainly my point of view, but I think there's this sort of myth out there that, you know, bond market liquidity is really dried up, and I think there are investors, or there are market participants that have an axe to grind in that. I think if you look at, first of all, the total size of the bond market is at an all-time high. So if there's a liquidity problem, it certainly hasn't affected the primary market. If you look at average daily volume, that's at an all-time high. If you look at indices of bid-ask spreads, that is pretty much at an all-time low. So these are metrics that are not consistent with the market, that there's somehow a liquidity problem. But I do think the automation, you know, and the use of data and the use of automation will shrink bid-ask spreads even further. It's a win-win for investors, all investors, whether you're buying the bond or selling the bond. The one it's not the win for is the dealer who's buying it at the bid and selling it at the offer, but making less and less and less as that bid-ask spread shrinks. So.
Thank you. Ryan, I wanted to ask you, so some people, I think some of the things that you described sound a little bit like high frequency trading, where you're trying to pick off someone who you know has fundamental demand, maybe get ahead of them a little bit. Do you feel like there are winners and losers from the data on flows? And also, would you be willing to be more specific on what that data is? Is that data that you buy, or is that data that comes across, you know, you and your firm as you're doing business?
Right. So I mean, I think we're not high frequency in that we don't have servers parked next to the exchanges and all that sort of stuff. But there is definitely an element of, can we predict what other people might do and do it first? And it actually, I don't know if this will exactly fit your question, but there's something we're working on right now where there's this, and this came up in the previous panel, I think it was a question from the back on this rise of passive investing. So passive investing is all rule-based, and if those rules are knowable, decipherable, and you can, you know, we actually have a code at the office that's designed to guess what these positions are and what price action would make them change. And if we can then run projections out into the future of what, you know, all these, you know, data generating processes throwing all these possibilities out, and in 30% of the possibilities, the passive investing community has these huge trades to do. Let's just do that trade now and hope for that 30%. I mean, that's becoming, so it's not so much, that's not a big data question, but where the big data comes in is we can test the idea once we feel like we've figured out essentially what these sort of passive investment firms are up to. We can then go back and we've got it down to the millisecond, every single trade that's gone on in the last 5 years, whereas maybe 15 years ago, if we had this idea, we just have to run it on faith. We can't go and see if it actually works. So that's, I mean, for us, data is a tool. So like, it's just, we've gone from having to sort of guess and hope that maybe something's going to work, or have very thin to non-existent statistical significance on the things that we're going to run, to being able to really rigorously try the idea out and put it through different environments. And so the data is so more frequent now that we can, you know, the stress testing that we can do is better, because we're not just looking at end-of-day closes like they were 20 years ago. And then even looking at when we're pulling external data that relates, I mean, this is kind of going off topic, but we had this big option surface data pull from Reuters, and the data was a mess. And we're like, this, like we had there's actually a UCLA math PhD student working on it, and he's like, I can prove on every single day there's a price that can't possibly exist because it was arbitrageable. And so we reported it back to Reuters. This data is incoherent, basically. And so we're like, here, try these values and see if that, we sort of suggested them what the price probably was, and then they actually incorporated it into their data set. But what that gives us the idea of, oh, maybe we found something that no one else, because now we literally have a data set nobody else has because their data was broken until we got it. So yeah, so I mean, those, I'm way off whatever you asked me.
No, I think I think the examples are really interesting. Okay. And you had brought up the example of the vol surface. Do you mind sharing what asset class that was in?
It was in physical commodities, so they're not. That's not something that most people are trading. I mean, we did. I mean, actually, I was trading soybean options today,
And I think the volume of the contract I was trading was 2 before I did the 32 that I needed to do. So now it's 34. But I don't know where the liquidity is coming from. It's there. We always make the joke, oh, it's the algo people, whatever they're doing. So, yeah.
Okay, so I do want to ask you one follow-up question, which is, you know, it sounds like some of the things that you've spoken about, like the roll date, or, you know, the passive investment threshold that something's going to cross is going to go from the top tercile to the middle tercile, so they're going to sell it. Are there asset classes where you think people will react more quickly to eliminate these arbitrage-ish opportunities that you have, and other asset classes where you think will happen more slowly? Or do you worry about the speed of the alpha decay as people figure out that they're getting picked off? Because these quant firms, they hire people for trade implementation to try to avoid this happening.
Yeah. So the thing with passive investing is it's hard for them to get away from it. There's just, if you're a AQR trend follower, you have to trade. You can't not trade. So if crude is up $2 today, they have to buy it. They have no choice. So they can try to, I mean, actually, this is another field of research for us. We analyze how firms try to hide what they're doing. Mm-hmm. And we've noticed that there's been this trend towards passively trying to sneak it through, and I'll do 2 here and 3 there and 4 there, and I wait for it to come to my price, and it's stealth trading. And so we asked the question, what if every single huge ETF and other trend follower is all trying to do this at the same time? I bet you it would make sense if we just did our trades 2 hours earlier in the day, hard, like hit them, like be liquidity takers. And that's been working. Like just, but again, if the data doesn't exist for us to pull and try these ideas out before we implement them, and then the data exists obviously to test and see if they're working. I mean, we'll never get to true. This is not what we do is not science because it's not repeatable, but we're as close as we've ever been to being able to feel like we're getting some significance from the data that what we're doing is working.
And just to be clear, the trade flow data is data that you purchased.
I don't think we pay for if it's
or it comes from a dealer.
Yeah,
because
I mean,
you're
if
a
it's
business
stuff
with them.
that's but like anything that's anytime we're asking for history, that can get really expensive. Yeah.
Mm-hmm, mm-hmm. Emmanuel, I wanted to hear a little bit about what makes your firm in terms of getting parsing textual data different, and how do you deal with the signal to noise problem?
Okay. So the first part I think is mostly, so there is a pure technology part, which is most firms, both finance and outside of finance, have approached any kind of machine learning under the same angle. Meaning, am I throwing images, am I throwing numbers, or am I throwing text? They'll still use the same algorithms. And then they will just tweak the parameters. And we think that's completely wrong. Because how that content is produced is completely different. Why that content is produced by people is also completely different. And the structure of it is also completely different. So the main differentiator we have on the technology side is actually algos we have developed. So one of my thesis advisors at UC Berkeley, myself over the past year, and then our CTO around we need to tailor specifically to text data how information is interpreted. And then we went even further, saying, okay, now that you have that, what is the proper technology infrastructure for you to run it as fast as possible, as cheap as possible? And that entails some extra things that will bore the audience if I go into it. But I find super interesting. And the second aspect is the hybrid of technology expertise and domain expertise. Right? So I mean, as you know, so I was at BlackRock running the securitized business on the quant side. That was 60 billion of investment. Right? One of our co-founders was at Goldman Sachs. He's an inventor of the credit default swaps. We understand investing better than a lot of people. So when we go into making a tech company to help investors, I think it goes really to are you trying to just spit anything you can out of a piece of data, or do you try actually to create a process that's verifiable, that's transparent, and that's adaptable? And that's the second advantage.
Okay, cool. I'm just going to open this up to all of you. Is there an aspect of big data, machine learning, data analytics that you think has been the most overhyped?
deep learning.
Okay, deep learning, why?
Because I think it gives false hopes to people that you throw garbage in, you get a miracle out, and you don't need to understand it will still be working.
Yeah. I mean, this is a pure cynical statement, but Winton spent a huge amount of money to develop their HiveMind strategy or whatever it was, deep learning team, and then all of a sudden they decided, you know what, let's share this with the world. Essentially, let's spin it off and get it the hell out of here. So, I mean, if it was, I mean, this again, the cynical statement, if it was truly working and valuable, why did they do that? You know, so, I mean, it kind of fits in.
Yeah, I have a friend who works on sort of big data analytics technique, and well, actually, and we had the chief economist from Amazon here, I think it was last year, and he was a former Stanford economist, and he said, look, there's no difference between big data analytics and panel data econometrics that we've been doing. You don't, as an economist or a financial economist or finance practitioner, you don't start with a data set and just throw a computer at it when you know there are certain rules. If there's not going to be a central tendency, there certainly are some like arbitrage bounds that are gonna hold there. So deep learning is the biggest hype. What about drones over parking lots, or over agricultural fields, or maybe over shale fields?
Well, I would just say, you know, I welcome all this stuff. Again, you know, the more people looking at securities, the more people analyzing, you know, the number of cars in the parking lot and every other thing about a company, you know, the closer and closer that price is going to go to where it ought to be. So again, for us, they're big proponents of the, you know, price is the hero of our story. You know, in the liquid public markets, we love big data. So
yeah, and I mean, I don't know if you read the story about the picture for this black hole, where there was so much data collected to get this picture that they had to physically transport it because it would take too long to send that data. I mean, that's where, but the key difference there is that the black hole was there, and if you take that picture tomorrow, it'll still be there. I think that's probably why deep learning has such a hard time with investing, is that what you're looking for is, maybe this is what you're saying with the central, that it's not a stationary, permanent object that you can go find, like the way that Google can get really good at understanding what you might want to buy. So they have 10,000 scientists working on that, whereas we have 5. I've never had a team more than 5 people.
I completely agree.
Okay, I have kind of a question that was spurred by something that you said, Dave, which is, so if we have big data and we have price as a fundamental, why do we see valuations that seem to be so far from fundamentals these days? This is kind of a puzzle that I've been dealing with. So we should be able to learn better about the fundamental value of a company, but we see prices moving further away from earnings, from book value. So is it a problem with earnings, with book value? Is it a problem with valuation? Or why is this big data?
No, I don't know that it's a problem with valuation. I mean, I think, you know, in the end, you know, I'll speak to my area, you know, in the bond market, you know, investors' risk aversion ebbs and flows through time, right? So sometimes, and people use the term, you know, fear and greed, and like I think about credit spreads in the corporate bond market. You know, sometimes investors think about, you know, late 2008. Investors were demanding massive premiums to take that corporate bond risk, and other times they're willing to take corporate bond risk with, you know, very small premiums. So investor risk aversion also has to be factored in. So when you know, prices seem low on corporate bonds and credit spreads seem very, very wide, I wouldn't mark it as a, you know, but you know, the valuation is wrong. I'd say this is where supply and met demand, you know, factoring in, you know, the current climate for or appetite for taking risk. So.
Okay, can big data help us understand changes in risk aversion? Like sentiment, right? I think there have been some advances in using textual analysis.
I'll just be brief on that, and, but I would say. You know, I don't know that big data could help us predict it. You know, if it could, someone's gonna make a lot of money. But I think we have enough, even without big data, to, you know, get our arms around, you know, risk aversion. I mean, we could observe that in prices, you know. But yeah, like I said, if someone could figure out in advance changes in risk aversion, there's a fortune to be made.
So the context of that would be that maybe you can pick up when the next crash is about to happen.
Or if you're trying to think about the decomposition of, you know, if you're looking at a PE ratio and you think it's rich, can you decompose that into misvaluation and low risk aversion? And can you use some sort of data to help think about that decomposition? So, big data to measure earnings better, or data to measure risk aversion better?
Yeah, I mean, I don't have a great answer for that.
Some of the inputs I have on that, again, very centered around text. So what I tried obviously in MBS with numbers failed completely. In text, what we found is, so sentiment is an angle which is very helpful, but what's more interesting is actually the distribution of sentiment around key subjects. For example, if I talk about trade war, people will say, oh yeah, that's a negative for a lot of asset classes in the US if it goes worse. What's interesting is to go beyond and say, okay, of all the people who contribute to the opinion that this is negative, what is the level of agreement? Because if they are all in extremely high agreement, you're more likely to see an adjustment in the price of assets faster than if overall people say, yeah, it's bad, but some people think it's catastrophic and some people think it's marginally negative. So one thing we started incorporating in the tools we sell to people is how do you measure the level of agreement among different contributors to a subject based on how they are expressing their opinion of that subject. What we found through feedback, since we don't provide signals, but what we found through feedback of users was that where it's helpful is it's never short term. Right? And it's in a way that so far they haven't been able to backtest. So they've more illustrated it through anecdotal stories of, oh yes, indeed, this event a few years ago out of Asia, you see that there is actually very high agreement, but the price of securities basically doesn't reflect that. So when finally you have an extra piece of news coming out, market is gapping. So the way they are approaching that is around typically value at risk management versus a catastrophic event and do you buy a deep out of the money put to preserve yourself for 5 years down the road.
Ryan, I want to come back to you because I didn't want to put you on the spot about measuring risk aversion. I think that's something that's pretty hard to do. I wanted to ask you about how scalable is the business that you're in. So are there constraints on scale? Because if not, why isn't everybody getting into this business?
Well, yeah, I mean, there are, and it's because, I mean, this is something that, so we'll have competitors come out and say, we're trading frontier assets, like things that we're trading the electricity futures or swaps or these various things that no one else is trading, and our capacity is $2 billion. And it's like, okay, well, you're telling your clients you expect to make 10 million or 10% per year. So that's 200 million per year that you're going to win. Who's going to lose 200 million to you and why? Like, so that's capacity constraint. It's I mean, this isn't true of all markets, but it's certainly true of ours, that it's a zero. Anything that we make, someone has to lose. And so, and they lose perhaps for, maybe it suits this is where we get into investor preference. I've had this conversation with people and they say they're not losing. This is part of, I mean, it's essentially insurance to them or something like that. And that's how futures markets were founded, basically, was on agricultural producers wanting to offset risk, and speculators would take on that risk for some expected return. It's the only way the market can clear is if there's winning, if both sides win. So, I mean, then to the practical answer to the question is it comes down to some percent of the underlying market size. So, if we're trading cocoa or coffee or something, those are not big markets, or palladium versus 10-year notes or S&P futures, things like that. Those are orders of magnitude larger. So it gets down to the larger you want your capacity to be, the more narrow you have to focus your strategy, and therefore the less likely it is to have an above average Sharpe ratio. So it's almost, I mean, actually what you'll see is these firms come out of the gate with really strong returns, they grow, and then they have to shrink their universe, and they become kind of average. And that's just, I mean, before Roe, I was at a firm that went from very small to 14 billion, and that's how that was our profile. Now the thing is, our investors were fine with it. We were consistent and good and had a great two-way relationship. But yeah, I mean, that's the issue is how strong, like there's an inverse relationship between how good you want to be and how big you can get.
That makes a lot of sense. And I'm wondering how, so if you're looking at dislocations relative to a model, or you're thinking about some algorithmic trading causing a dislocation from fundamentals, how do you filter the universe? It's very big. And how do you think about those smaller, less liquid markets that might have more dislocation versus a bigger market with more capacity? Do you do it all?
Well, I mean, we like to start with the idea that all markets have equal opportunity. But it's just that as you get larger, some of them become, like if we were 100 times bigger and I had to sell 3,200 soybean contracts today, it's not possible. Like that's I'm sure more than was traded on that whole curve today. So the reason that we were doing that trade, I guess the edge behind it is doesn't have capacity or even not 100 times or not even 10 times the size we are now. I mean, besides that, the CME doesn't allow you to have a position bigger than 6,000 anyway. So there's limits there as well.
Dave, I wanted to ask you whether you think any of the innovations in bond markets in terms of trading or information available will lead to financial innovation there. So we actually saw sort of financial disintermediation in corporate credit markets. We saw single name CDS trading volume at least go down, and we saw not agency mortgage markets basically disappear except for legacy assets. So can we have financial innovation now coming out of the new bond trading or new bond price discovery data?
Yeah, we certainly can have financial innovation. We'll always have. I'm not worried about innovation stopping. As long as there are MBA students like the folks out here, I think we'll have plenty of innovation. I think there's still ways to go, even with the stuff that I said, which is still a relatively small part of the market. There's still more beyond that, and on the, I could say on the fixed income side, algorithms are just starting now on our side of the street. So, and I know some of the dealers, at least word is that trades under, let's say 2 million. Some of them is all basically a computer setting the price, and I can see more and more of that happening. Also on the buy side, so the investor side will figure out, well, we're gonna, if they could write algorithms, we could write algorithms, and all our small trades, we'll just have computers trading with computers. I could see that type of innovation. But as far as like the types of like products, the next CDO or something like that. I mean, ultimately, when we look at the world equities and fixed, we basically see about a half a dozen what we call dimensions, drivers of return. And fixed income, it's term and credit. I'm not saying it's going to be term and credit forever, but it's not like these dimensions come along every quarter. We would think maybe these big discoveries in the field of finance. There might be landmark discoveries about on the order of like once a decade. Maybe it was like it went from CAPM, essentially a one-factor model for for about 30 years or so, right? And then all of a sudden, Fama French come out and say, well, there's a couple more, and then a couple, another one or two after that. So these don't come along every day. I think there will always be innovation, but I think it's the big breakthroughs are not. I think marketing folks would like them to come along every quarter, but I think finance researchers, you realize they don't come along that frequently,
Okay, great. I wanted to, kind of like Al did with Rick, I wanted to ask you guys if there's something you would recommend that people need to study, to train in before they go out. How is what you've seen about big data or machine learning, et cetera, changing the skill set that you think finance professionals need?
Yeah, I mean, I'm on the industry advisory board for the MFE program here, and I'm speaking specifically maybe more towards that tilt, but you have to know computer science, like heavy computer science, because I think that's going to become the liberal arts of the next 50 years, where if someone's not sure what they want to do, they should do that and then figure it out later. I mean, unless you literally want to be an English professor. Yeah, I mean, it's gotten to the point now where the barrier to entry in our space is so high that if you don't have some sort of really usable skill right away, and computer science is kind of a catch-all. There's really nothing. I mean, there's so many different places within a company that you can be useful and helpful if you have that background, and that's your foot in the door and you become invaluable to people, and then all of a sudden someone's like, okay, well, I'm willing to invest some extra time to teach you how to do this, which is going to be really valuable to you in your career. And that every like success story that we've had that's really how it started, is because if you come in with no ability to code, it's literally like it's almost like you don't speak the same language as everybody else on the desk.
What languages are you using most in your firm?
Well, what's funny, I'm stuck kind of in older languages, and so they're allowed to program in whatever they want as long as they bring it down to what I can understand when it's ready for production. Like I'm in like MATLAB and stuff like that. But yeah, I mean, I would say Python is probably the most, just because it's so easy to pull things from the internet or whatever if you're looking for help. And I mean, we're not super high frequency, so MATLAB's great too, or even like Excel, just because you can. We like to be able to touch and feel what we're doing, and those are pretty touchy-feely languages. I think they use R here, which is it kind of came along after I was out of school, so I'm not that, but it's pretty close anyway.
Yeah, it's matrix language. Emmanuel?
Kind of like similar opinion. The way I approach it goes back to what Ryan just said around the capability to communicate within your team. I've seen on my teams at BlackRock people who are pure quant, who therefore can never speak with traders, who never studied math in their life. And then you get to a day where the trader is like, okay, I don't understand why this portfolio wants to do that trade. And the answer is something like, well, the T-stat went up. That's not going to go well, let me tell you that. It did not go well. And then you have the other way around. You have people who have a very deep intuition of market, will be unable to explain it in a structured way to someone who can generate a structured representation of it. So to me, in the training, and I think overall MFE programs do that pretty well, and I think some other programs are training to that, is the fact that you shouldn't aim at only one side of the aisle. Whether you end up in a fundamental investing position or a quant investing position, I think it is important for you to have the ability to work with someone who's at the opposite end of the spectrum, because I think really the hybrid thought process, that's where good performance and innovation will come from.
Cool.
Well, I like these answers. I thought Ryan's answer about if you don't know what to do, be a computer science major is pretty good advice. But I would also say, a deep background in statistics, of course, will always help, because, as much as they're not, models are not perfect by any stretch. No one would claim that they are. But, being able to explain outcomes in distributions of statistical distributions is very, very helpful. I would also think optimization, something along those, figuring out how optimization models work, also very, very helpful. But even if you can't figure out those, if you know how to code it for someone else who does, then you'll have a job, So.
Yeah. Or actually, maybe I could just add. So touching on what you were saying, so like we have situations on our desk where a trader will be like, why is the size of this position keep going up? And they'll be like, well, the Garch this and all the vol models, and so this is just a standard risk position. And he's like, and this came up in the British pound recently, and it's like, you realize it's not moving because everyone's waiting for Brexit to come out, and then it's going to move a lot. And so there does need to be also stay in touch, like almost, I tell people, like, try to create situations where you can trade for real. I mean, California happens to be a state where poker is legal. Go play poker at Commerce or the Bike. Like, get in touch with actual betting and having money at risk, as opposed to sort of the whole thing being a mathematical exercise.
I think that sounds like good advice. We should all play more poker. And on that note, I'd like to open it up to the audience to ask these guys questions. This has been fascinating, so feel free. I don't know if we're passing mics around or if you want to come up down the center aisle. We have a question here in the front.
So I happen to be on the issuer side in fixed income markets, and I've seen bond prices fluctuate from 5% yield, $100, down to 100% yield, 10 cents on the dollar. And to me, what's changed in situations like this is extreme fear and lack of liquidity. So maybe the pricing is efficient, but I didn't think in those situations that the valuation was fundamentally sound. So do you reconcile between efficient pricing and actually efficient fundamental valuation in the markets?
All right, so one of the things I would answer that people often sort of mistake, efficient markets with perfect markets. So there's, even Gene Fama would not claim that markets are perfect. And I've heard people say, David Booth would say, I'm willing to say that half the securities out there are overpriced and half are underpriced. My problem is I can't tell which one is which. So in the end, there's a scorecard, and that's your returns. So I can tell you, 30 years ago, when I was first starting, at Dimensional, it felt more like we were fighting a holy war, active versus passive. We've moved way away from that, and the answer to us is, look, if there are market imperfections, then it should be fairly easy to outperform, and if you can do that, congratulations. That's where you're not the enemy, but when we look at the data, we look at data. Well, one just huge fact is this massive movement of assets from traditional active approaches to more passive approaches in ETFs. It's not happening by accident. It's not because the managers, the traditional active managers were so good at outperforming, for some reason their clients abandoned them. It's happening for a reason. And I always remind people, that's not a bad thing. In my opinion, the fact that we have well-functioning markets and information is getting impounded into price very, very quickly, we should all be thankful for that. So in the end, if there are market imperfections and people can systematically find them and exploit them, they should easily be able to outperform their benchmarks and make a nice living doing so.
I'm sure we have another question from the audience.
I had a question about the future of where you see data going in this field. Is there going to be an increase in granularity in terms of market data, like finding more and more things to go into, like individual trades, all that stuff? Will there be more trying to find hidden pockets of data that you can use to craft strategies around? Or is it going to be more about kind of knocking down and reducing the barrier between quant and qual in terms of kind of like tech sentiment and things like that?
All three of them. That's basically my view. I think, for example, like Trace is a great example. I mean, I remember, to me, Trace was a huge upstep for everything in MBS. That's an example of more granularity, and realistically, it will go further. Like right now, so I haven't checked in a year, but last time I checked for MBS, trades, for example, was still aggregating several tickers together because dealers are heavily lobbying against more details.
This
of course,
morning,
they're making
this morning in Washington, D.C., the fixed income market structures advisory group, basically they're pushing back on Trace and looking to delay dissemination of the large trades. So it's happening today. And we're trying to be as vocal as we can to say, no, we think there should be immediate and complete dissemination of data. So it's a tug of war that just continues.
There is, but I think that's the direction, right? Clearly, there will be a push toward more granularity. The second aspect around finding the right packet, a corner niche of data, that's the job of anyone who is here to beat benchmark, right? You need to find the right data so that you can answer the right questions versus you just go pray for the best and see if you get lucky. The third aspect, which is, I think, just a different way to analyze data and a blur of the lines where I think some people will not need to know that much computer science to benefit from computer science to analyze data. And conversely, some people may not need to know that much about investing. Typical robo-advisor, prime example. Right? You don't need to know anything about investing. That platform is guiding you by saying, hey, we have PMs and a handful of researchers that are making it easier for you to do a 60-40 portfolio with a fake tilt on top of it. So that's kind of like my view.
Just one interesting, there's new pieces of data coming out all the time so that you could tell it's still exploding. The latest one that we saw that was neat, that would matter in our space, is satellite photos of oil tankers or something like that late in the day so that you can see the shadow off the boat to tell how much
how
stuff
heavy it is
on the boat. So, obviously that data was not available even 5 years or even 2 years ago. So, and you mentioned the drones and there was rumors that hedge funds that were short banks were paying people to stand in line at the bank to make it look like there was runs on the banks. So that's sort of trying to play a countermeasure on data collection. But still, it's just amazing how it keeps new people think of new things that might be interesting, And then really the job of our job is to figure out, well, what data is actually going to provide return, because you don't want to be a situation like the gold rush where the people made all the money was the one selling the tools. Like, you want it to be it's us finding something.
So one last question, if there was a dream data set or piece of data that you could have, what would it be, and how much would it matter if everyone had that data or just you did? It's kind of a tough one.
I don't need data to make money. I sell tools to help people dig gold from the data.
Ryan doesn't want the tool maker to make money, so I guess he's going to think of the magic data.
The tools, but I got to, yeah. I mean, I think it's awesome that there's people who make the tools, and then there's people who find the information that.
You're making tools at your firm too, because you got coders.
Well, we do. Yeah, but in my analogy, the pickaxes is the new cool data that we never had before. So I mean, that's this particular one with the tankers. I think it's a little too. It's a little too esoteric or narrow for what we're trying to do. But yeah, I think the problem for us is everything we trade is really big. Like if we trade single name stocks, probably the answer would be different.
Yeah. Yeah, well, I'm sure some data provider will come up with a data set that everyone will pay a lot of money for. Probably it's actually owned by some firm already, and I think that's also a very interesting question that maybe we can talk about in the break, is how do you value the data that some of these new firms have? But let's just close by thanking these amazing panelists and all the audience.